Howdy everybody and welcome back to another stock analysis video. Today we are going to be analyzing the company Best Buy, a company that I've actually analyzed here before on the channel. However, seeing that their earnings are actually coming out on Tuesday as you guys are seeing this video, let's see if this stock price actually matches this ticker price. And also I'm going to give you guys a couple of my opinions as to what I think might happen or what I think we should be doing with this company based on something that I've talked about, however I've never really delved into. So with that said, let's get started with this analysis. Starting off with a dividend summary, Best Buy does pay a pretty good dividend, and guys, the price is very cheap right now according to the PE. We're going to see that in just 1 second, but look at this dividend yield, guys. 4.86%, almost 5%, which ends up being 88 cents per share for an annual payout of a whopping $3.52. The payout ratio in regards to the net income is around 29.75%, which is good. Very good. Anything under 60 for me, I like to take. However, let's take a look at this in regards to the cash flow in just 1 second. Now, coming over here to the growth rate on this dividend, it's actually very good. 20.36% with a dividend growth of 8 consecutive years. I would personally like it if this was close to like the Dividend Aristocrat, right? 25 years or at least 10 years, but nonetheless, 8 consecutive years is not too shabby. Ex-dividend date unfortunately passed as of March 23rd. Payout date was April 14th, and they pay their dividends quarterly. Now let's come over here to the calculator. We got the ticker symbol of BBY, market cap of $16.3 billion, PE guys of 7.35, with a current share price of $72.36. So just based off of this PE is telling me that based off of the earnings, this might actually be a pretty decent price to buy that. However, we're going to take a look at other metrics just to make an even more accurate representation of what we should be paying for this company. Now, with this $3.52 that we just saw when it comes to their annual dividends per share, based on the amount of shares outstanding that they have, they only pay out $800 million, which is actually fairly surprising. And in regards to the 5-year average free cash flow, after this $800 million is paid, they're still left with around $1.5 billion, which ends up being a payout ratio in regards to the free cash flow of 34.5%. Very good, very healthy, not even gonna lie. And seeing that the payout ratio is actually this low, this tells me that they are able to continue to increase this dividend for starters, as well as they still have plenty of money left with $1.5 billion in the 5-year average to continue to buy back shares and grow the company. Taking a look now at some fundamentals, starting with the net income 5 years ago of $1 billion on the dot to 1 year ago of $2.4 billion, increase of 145%. Guys, this is one of the best net incomes I have seen yet. You can see very steadily going up. There are a couple flat years, kind of, I guess you could say, like for example, 4 years ago it was around like 1.46 billion, and then 3 years ago it went up to 1.54. Yes, there was an increase, but it wasn't enough of an increase for you to actually see here on the chart. It is an increase nonetheless though. Just I'm arguing semantics here. Nonetheless, when it comes to the net income, this looks amazing. Coming over here now to the free cash flow, cash from operations less your capital expenditures. This is essentially the lifeblood of the company. 5 years ago of $1.4 billion to 1 year ago of $2.5 billion. Now, while this is an increase of 73% with a 5-year average free cash flow of $2.3 billion, we can see here that they did have a massive outlier, ironically enough, during COVID, where they shot up to $4.2 billion. Now, the reason why this probably happened is because Best Buy mainly does retail in the sense of computers, phones, that kind of stuff, right? Electronics, essentially. And we all know that because everybody was locked down, well, people began, doing a lot of streaming, people began ordering, people began using a lot of technology in general, which explains why their cash flow shot up 2 years ago. Even with this anomaly, you could see that they continue to slowly increase their cash flow consistently from the past 3 years ago to 1 year ago. Taking a look now at the revenue 5 years ago of $42.2 billion to 1 year ago of $51.8 billion, increase of 22.8%, very steadily increasing. There's nothing else to say here. This looks amazing. Now taking a look at the total assets minus the total liabilities. This tells you if the company were to liquidate all of their assets, would they be able to cover their liabilities for starters, and by how much? Now currently, you have to give them credit, they are able to at $3 billion. However, if you just take a look at this graph, they are decreasing this difference of assets and liabilities year over year. 5 years ago, they were at 3.6, and then 2 years ago, when COVID happened, they shot up to 4.6, and then after that, they went down to $3 billion, as we just saw. Yes, they are able to cover it for now. However, their assets are definitely decreasing and their liabilities are definitely increasing. Now, with all of these numbers, this comes out to be around $16 billion in average total assets, average liabilities around $12.4 billion, and doing the average assets minus the average liabilities, we get around $3.5 billion. Now taking a look at one of the most overlooked metrics in the entire investment community, and that is the shares outstanding. Guys, I can't stress this enough. Yesterday we did Zoom and you just saw like the massive shares dilution that Zoom was doing. Now, Best Buy is actually doing the opposite. Best Buy is actually being good when it comes to their shares outstanding and rewarding their shareholders in share buybacks as well as a dividend. 5 years ago, they had around 283 million shares to today, guys, of 227.4 million shares. That is a decrease in the 5-year of 19.65%. And from the previous year to the current year, we're looking at 2 years ago to 1 year ago, they bought back a little bit more than 11.5% of their shares. This is actually really, really good. They are decreasing their shares out there, which not only does it give you, the investor, a bigger piece of the pie, it also lowers their payout ratio as well, because these are shares that they no longer have to pay out a dividend with, right? Because they're not going to pay themselves a dividend. They just don't issue the dividend for the shares that they own. So right then and there, by buying back shares, they are increasing the value of the shares that you already have, as well as lowering that payout ratio, which gives them a chance to continue to increase that dividend. And lastly, taking a look at the cash equivalents, they currently have $3 billion with an average cash of around $2.8 billion. Now let's make some assumptions. We're going to do a low, median, high assumption, 3 different factors: revenue growth, predicted share buyback, and required rate of return. Guys, revenue growth, I like to use Seeking Alpha's growth tab, looking at the year over year and the forward, and making a conservative assumption between those two numbers. The closer those two numbers are to each other, the easier it is for me to make the assumption. The farther away they are, the harder it is. Predicted share buyback, we just saw the shares outstanding graph, so I'm going to be taking that as a reference. And for the required rate of return, I'm going to keep it flat 10% to match the S&P 500 on the best years. So let's say that for the low assumption, I'm going to put a revenue growth of 2% and a predicted share buyback of 3%. Well, doing so, this gives us a target share price of $159.56. For the median assumption, revenue growth of 5%, predicted share buyback of 6%. This comes out to be $182.68. And lastly, for my highest assumption, my rosiest assumption, revenue growth of 8%, predicted share buyback of again 8%. This comes out to be $206.58. Now let's adjust for debt. And this is why we take a look at the cash and equivalents. And when you put in the fundamentals for the stock fundamentals tab, you have to put in the net debt, because this tells you how much we have to pay for this company adjusting for debt. And we do this by taking the cash and equivalents and the net debt. If they have more debt than cash, this number comes down. If they have more cash than debt, then this number comes up. So you can see it does come up by a little less than $10 to $168.33 for the low assumption. For the median assumption, $191.72. And for the high assumption, $215.80. Now, me personally, I like to add a margin of safety of 5, 10, and 15%. You guys could change these numbers to whatever you want, right? I mean, you guys could put 10, 15, 20, whatever it may be. I personally like 5, 10, and 15%. And this gives us a nice cushion of entry as to where we might put this company at. You don't want to overpay for something, right? So, adding this 5, 10, and 15%, I personally would like to buy between around $143 to $160 for the low assumption. For the median assumption, $163 to $182. And for the high assumption, $183.43 to $205. Guys, the current share price is $72.36. So as it stands, this is an all-out buy. If you believe all of these assumptions, right, as well as the required rate of return, even as well as my margins of safety, then this is an absolute buy at the current moment. Now let's say that you don't believe this. Let's say that you don't believe that Best Buy will continue to grow at 2%. You think that they're actually going to go down to like negative 2%, and that they're going to actually start issuing shares at like, I don't know, negative 5%. Well, right then and there, you just see how much of a difference that causes when it comes to the target share prices. So it really just depends up to what your assumptions are. I personally don't believe that that will happen. However, Nonetheless, I have this, guys, available for everybody, this calculator, as well as a book value ratio 1 and a dividend tracker, all for free. All I'm asking for in return, guys, is help me grow my channel. Like, subscribe, comment. Thank you so much for the 600 plus subscribers. Oh my god, I cannot. When I saw that, I was just oh my god. Thank you so much. Really appreciate it. Help me grow my channel. I am currently working on a REITs calculator. Hopefully I can get that to you guys as soon as possible. Hopefully maybe by this upcoming weekend, maybe. We'll see. But nonetheless, that's all I'm really asking for, guys, is help me grow my channel. That's just about it. Now, before we move on to the dividends at the current share price, I would actually like to point something out in regards to this company. And that is the fact that, well, we just got here the target share prices. However, there is something that I really do need to point out, and that is something in their 10K. Now, I've never really gone in the 10K, at least in my videos. However, I will do that now. And when it comes to retail, guys, this is something that you definitely have to take into account. Because, well, when I first did Best Buy in my previous video, I actually had an epiphany as to, like, I wonder how many stores they actually have open. And I looked this up on Google, and then I found out that they're actually closing a lot of stores, and that's not good. In fact, looking over here at the 10K, well, we can pretty much just see that they have a statement right here saying, we currently expect to close approximately 20 to 30 Best Buy stores annually through fiscal year 2025, consistent with prior year trends. So that needs to come into also to your assumptions when you use this calculator and say, I think this is going to grow at this percent, or I think they're going to buy back this much shares, because we just saw right there that they are planning to close down stores. The more stores they close, well, the less revenue they'll have coming in, meaning that this revenue growth will have to go down. So it really just depends as to what effect you think this will have. Now, they may be closing stores because they may be like, oh, we just think that our online sales are significantly higher, right? But nonetheless, closing of stores is definitely something that will impact their revenue. Something to take into account. Look into their 10K and look into their 8K and do more research on that if you so wish to do so. But now let's take a look at the dividends at the current share price. Guys, this company pays a massive dividend. Okay, I mean, we just saw that, and the current share price is really, really low. So let's take the average US income, $68,703. Bring it to the monthly, $5,725. If you were to put in 1 month's income into this company at the current share price, this would buy you 79.12 shares, which at the current annual dividends per share, this would give you guys an increase in annual dividends of $278.51, quarterly dividends of $69.63, and a monthly dividend of $23.21. That is amazing. The fact that with $5,725, you can essentially grow your annual dividends income by almost $300 if you round up. That's amazing. That's absolutely amazing. Now, again, this does come with risk in the sense that, yeah, they are increasing pretty much everything. However, we just saw that they are closing their stores. So I don't know where you would necessarily put that. But nonetheless, when it comes to dividend play, this is looking fairly good right now. All in all, guys, Best Buy is a company that I currently am considered buying. I'm not even joking about that. And seeing what we just saw with Target and Walmart, two other huge retailers, we might see the exact same thing with Best Buy. So come Tuesday, well, we might see Best Buy's share price fall even more than what it is now, based off of what their earnings and projected outlook might be in the future. Then again, I don't necessarily know, because Walmart is an overall store, so it's kind of Target. Best Buy is mainly geared towards electronics, so I don't necessarily know what we're going to see with that. But nonetheless, this could go even lower in a couple days when you guys see this, when the earnings come out. Am I telling you to buy it? No, this is not financial advice. Showing you guys just raw numbers and my assumptions. Make your own assumptions, and you see if whether or not you want to buy this company. That pretty much is it for this video. Like if you like, comment, subscribe. It really does help here with the algorithm on YouTube. You can follow me on my music sites of BitChute, Odyssey, and Rumble. Also have a Let's Play channel. Links are all in the description below. So if you want to see that, you can follow me there. With that said, peace out, and I will see you all in the next stock analysis video.